Hello everyone, you're watching weekly number 6 on Oil and Gas Investor Channel. The main topic of today's episode is, of course, Iran. Let's briefly review the oil and gas markets so we can focus primarily on Iran and how to profit from the unfolding situation. Let's start with the gas market. Over the week, prices of natural gas in the US declined by 6.2%. In our view, in March, prices may fall to $2.5 per million British thermal units, which is 12% below current levels. In the second week of March, US gas storage may shift from withdrawals to injections, which would put additional pressure on prices. That means we may once again generate returns on the ETF KOLD. Our traffic light signals a high probability of further downside. The only supportive factor remains the extremely low level of gas inventories in Europe. As of February 27th, European storage levels declined to 30.1%, significantly below the 5-year average of 46.3%. Now, let's move to the oil market. Last week, WTI prices gained a modest 1.5%. However, since the beginning of the year, prices have risen by a more impressive 17%. The rally was driven by lower OPEC Plus production and a higher geopolitical premium due to the situation around Iran. The war with Iran has been ongoing for more than 24 hours, and some conclusions can already be drawn. As we forecast, Israel struck Iran first, and Iran's main retaliatory strike was directed against Israel. However, since Israel is far away and has the best missile defense system in the world, the Islamic Revolutionary Guard Corps is attacking neighboring countries. Israeli and US forces have established full air superiority by destroying Iran's air defense and missile defense facilities. In our view, within a few days, missile stockpiles, launchers, missile and drone production facilities, as well as rocket fuel infrastructure in Iran, will be destroyed. The main objective of Israeli and US military forces is to reduce Iran's ability to conduct missile and drone strikes beyond its territory. Most of Iran's military and political leaders have been eliminated, including the supreme leader of the Islamic State, Ali Khamenei. The command and control system has been destroyed. Iran's retaliatory attacks are chaotic and not massive in nature. A large number of strike aircraft and aerial refueling tankers in the region means air control will be maintained continuously and for an extended period of time. This means the US and Israel will not stop the operation until the regime of the Ayatollahs is destroyed. There have been no reports of strikes on oil and gas facilities so far. The US and Israel will not target oil and gas infrastructure. The United States will take all possible measures to prevent oil prices from rising. This may include releases from strategic petroleum reserves and temporary easing of sanctions on Russian oil. The risks of higher oil prices are more likely tied to Iran's actions. Facing imminent collapse, the Iranian regime and the Islamic Revolutionary Guard Corps may attempt to block the Strait of Hormuz, through which around 25% of global oil exports and significant LNG volumes pass. In our view, oil prices may spike on Monday, but the move is likely to be short-lived. It may finally create an opportunity to initiate short positions in oil stocks. At today's meeting, OPEC Plus countries decided to increase oil production quotas in April by 206,000 barrels per day. The group may continue increasing quotas at the same pace through October, adding around 1.2 million barrels per day to the market over 6 months. The next meeting, where production quotas for May will be decided, will take place on Sunday, April 5th. We expect that in May, WTI prices may fall toward $50 per barrel. Recall that in the second half of spring, oil demand typically declines as refineries enter scheduled maintenance. Now let's move to the investment portfolio. First of all, we once again generated returns from falling natural gas prices by buying the KOLD ETF on Friday, February 20th, before the market close. On Monday, KOLD gained 4% and we closed the position. By opening positions on Friday and closing them on Monday for 4 consecutive weeks, we generated more than 75% in total over the month. This week, we did not open a KOLD position, as we were cautious that natural gas prices could rise on Monday due to the attack on Iran. If prices increase early next week, we will buy KOLD again. At the moment, our portfolio only holds the USO ETF, which we bought on February 13th. If oil prices rise on Monday, we will likely lock in profits on this position. The main trading idea for the spring is shorting US oil industry stocks. Our top short pick is oilfield services giant Baker Hughes. The company benefited from producing energy equipment for LNG plants and data centers. Hype around these segments drove the stock higher. However, share price growth has significantly outpaced actual results. In 2025, company revenue declined by 0.3%. In our view, Baker Hughes shares have downside potential of more than 30%. Technically, the stock also appears heavily overbought. The second overbought stock is ExxonMobil, with downside potential of around 20%. The rally is tied to unjustified expectations that the company will generate substantial profit from resuming operations in Venezuela. Technically, the stock also looks overbought. The third short candidate is refiner Phillips 66. Shares rallied on the idea that the company would receive cheap Venezuelan crude and significantly expand refining margins. Downside potential is around 20%. Technical indicators also point to a correction. In summary, our portfolio currently holds a long position in ETF USO, and we plan to open 5% short positions in Baker Hughes, ExxonMobil, and Phillips 66. Subscribe to the channel to stay up to date with the key developments in oil and gas markets. Leave the stocks you're interested in the comments, and we will discuss them in upcoming videos.